Welcome, everyone. We are pleased that you have joined us for today's webinar entitled Yours, Mine, and Ours, Choosing Bonus, Split Dollar, or Deferred Compensation. The webinar will last approximately 15 minutes, and at the end, you will be given an opportunity to receive supporting materials by email, free of charge to you. You will also be told how you may email questions related to today's content to the presenter. Today's presenter is Linus Sugis. Linus worked for a Chicago-based insurance company in various roles, including Director of Advanced Sales and as Chief Marketing Officer. He ran and sold a successful estate planning law practice. Linus also writes the publication Think About It, founded by life insurance industry guru Steve Limberg, and regularly speaks at industry events. His new book, Sell Out, The Busy Entrepreneur's Guide to Transferring a Closely Held Business, written together with a CPA and a business broker, is now available on Amazon.com. Linus will draw on his legal, tax, life insurance background, and practical experience for today's webinar. And here he is.
Thanks, Jennifer. Good morning, everyone, or good afternoon, depending on where you're at. We're going to talk today about bonus plans, split dollar, and deferred comp, and we're going to go through them quickly. We get asked quite a bit about what the best kind of employee benefit life insurance based plan is, and of course we give the good lawyer's answer, it depends on the circumstances. For the purpose of today's webinar, we're going to assume that the employer is interested in providing an employee benefit that is life insurance based for an employee. Could be the owner of the company, or it could be a non-owner of the company, but the point of the life insurance is to provide, in an employment circumstance, an employee benefit. And in general, what the employer has to sort through is which is the best fit. Is it a bonus plan? Is it split dollar? Or is it deferred comp? And so we'll talk about that in some detail. But I think the main takeaway that both Jennifer and I would like you to take away is, if you're not particularly experienced in this market, this may come as something of a surprise to you. The main takeaway is that in 95% of the cases, or thereabout, in our experience, it's going to be a bonus plan that's the best fit. And it is going to be a bonus plan primarily because of a bonus plan simplicity. Both split dollar and deferred comp require more work to implement properly. And so the bonus plan, because it's the easiest to implement, and because in some cases it can provide a net tax deduction for the employer, it's going to be the best fit. Now, there are some exceptions to the rule, and so we're going to go through all three of them so that you understand how the exceptions do prove the rule. But bonus plan is going to be the right fit in most of the cases. So let's talk a little bit about choosing between these. I think any time you talk with a business owner client, you're going to want to ask good questions about what the insurance is intended for, and you're also going to want to have good information about how the plan is intended and how the business is organized. You're going to want to know things like who's going to be the insured, what are the tax brackets, how is the business taxed, what's the purpose of the benefit, how important is control for the employer or the employee, and how much cost and hassle is the sponsoring employer willing to incur if control is important. All of those things are things that you're going to want to ask the business owner about to make sure that you're putting in the right arrangement. So let's talk about bonus plans to start off. So when we get callers who ask about 162 plans or bonus plans or executive bonus plans, we usually start by explaining this, and that is A bonus plan is nothing more and nothing less than the employer paying the participating employee extra, and that extra being used to buy life insurance. That's all it is. The employer pays an employee extra, an extra bonus, and the extra is used to buy life insurance. Now, the extra doesn't have to be used to buy life insurance. You can have an annuity bonus plan. You can have a lawnmower bonus plan. But that's it. The key is the employer pays the employee extra. So when life insurance is used, the employer and the employee agree that the employer is going to pay extra and that the extra is going to be used for the employee to buy personal life insurance. The employer gets to choose who the extra is being paid to. The employee owns the coverage. The employee names his or her own beneficiary. The employee exercises all ownership rights over the policy. And if the employer stops contributing, the employee's got to decide what to do with the policy, whether to surrender it or to pick up the premium stream. The extra that an employer pays to an employee is generally income tax deductible by the employer, by the employer's company, right? As long as the amount of compensation is reasonable. And if we're talking about a non-owner employee, almost by definition, the amount's going to be reasonable because the employer is not going to pay an unreasonable amount to somebody who doesn't own the company. The only time when reasonable compensation becomes an issue is when it's the owner of the company. But in most cases, that's a non-issue. One important thing to note, and this is going to be relevant as we talk about split dollar and deferred comp later on, in order for the employer's premium contribution to be tax deductible, the business cannot be in any way an owner or a beneficiary of the insurance policy. If the employer is an owner or a beneficiary of the insurance policy, it may not take a tax deduction for the amount of the premium that it's contributing. And that's Section 264 of the Internal Revenue Code for those of you who are keeping score at home. It's the most quoted code section that Jennifer and I use. Section 264 says you can't take a deduction for life insurance premium if you're an owner or beneficiary of the contract. So there are different ways to set up bonus plans. One use is for a third party to be the owner of the contract. The employee, including the owner employee, may decide to set up an irrevocable trust for estate tax purposes. That trust may be the owner of the contract. It's still possible for the employer to pay the employee extra, deduct the bonus, and the employee, including an employee owner, would include the extra that they're being paid in their personal income. And then the bonus would be treated as a gift to an irrevocable trust in the example that I cited, and that could work nicely. It's possible to structure a bonus plan in a regular implementation as a single bonus so that the employee gets paid exactly the amount of premium for the life insurance. It is possible for it to be a grossed up or a double bonus so that the employee gets not only the premium covered, but the tax on the extra that they're being paid, so that there's no out-of-pocket cost for the employee. It's possible to customize a bonus so that both the employer and the employee contribute something to the policy. All of that is possible. Now, we get asked quite a bit about a restricted bonus plan, and people wonder whether implementing that makes sense. And while restricted bonus plans do have their place and do have their advocates, I think two practical things keep restricted bonus plans from becoming more popular than they are now. The first, and people often overlook this, the first is that if you have a restricted bonus plan, the employer cannot get any of the bonus back. If the employer does have the ability to get the bonus back out of the policy, that defeats the ability of the employer to deduct its premium contribution, which is one of the positive aspects of the bonus plan. The employer cannot get its money back and still have it called a bonus arrangement. And so that's one of the things that stands in the way of restricted bonus plans being more popular. The second thing is that in the real world, employers want to customize how these restrictions work. In general, it's a question of the timing of the employee's access. That's what can be controlled, the employee's access to the cash value. But if they want to customize the timing of that, usually it requires an agreement, and such an agreement usually needs to be drawn up by the client's attorney. Well, one of the virtues of a bonus plan is that it's dead simple to do. If it requires a trip to the client's lawyer to implement a bonus plan, that takes away one of its main advantages, and so it makes restricted bonus, I think, a less popular technique than it might be otherwise. So that's a quick overview of bonus plans. The main virtue, deductibility of premium, dead simple to implement. The main drawback is that the premium, the amount of the bonus, has to be included in the employee's income, including the employee's owner. And so for the owner of the company is getting paid extra, that's deductible business expense, but the extra has to be included in the owner's personal income. That's a taxable event. That doesn't feel special for the owner of the company, at least not tax-wise. Having said that, our business owner clients like the idea that they'll use business money to pay for needed personal life insurance, and so that's why it's used quite a bit. It's used in a lot of situations: by self-funding, extra needed personal insurance, putting money aside to help supplement retirement while also providing life insurance protection. All of those uses are uses for a bonus plan. Now, split dollar plans are a more sophisticated way to buy life insurance. In general, the employer and the employee might contribute to a split dollar plan, and the benefits of a split dollar life insurance policy are divided up. Since 2001, the IRS has come out with fairly specific rules about how it is that split dollar plans can be set up. They're set up under one of two kinds of designs: the economic benefit design, or the economic benefit regime, or the loan regime. Now, the economic benefit regime is the way that 15 years ago we used to think about most kinds of split dollar plans. And that is, the employer might pay all of the premium, the employer might own all of the cash value, and the employee would pay income tax not on the whole premium, but on just the death benefit portion, the right to receive the death benefit portion in any particular year. And so the IRS said that the value of what the employee receives, if the employee doesn't own any of the cash value, the value of what the employee receives is the value of the death benefit. And that's calculated by looking at a term insurance table, a one-year term insurance table, and the employee's age and the amount of coverage that's in force, and coming up with a value. And that's, in early years, generally much less than the premium that the employer is contributing. And that's the advantage of such a plan from an employee's perspective. So for a non-owner employee who needs personal life insurance, that lower income tax cost can be an advantage. It can also work in limited circumstances for an owner employee. And in general, it works pretty well if an owner employee is creating an irrevocable life insurance trust, and they want to control the gift tax cost of the life insurance policy as it's being gifted to the trust. The employer might pay the premium for an ILET-owned policy through the economic benefit regime through a split dollar plan, and the gift tax cost would simply be the ART rate every year, and that's the good news on the front end. Now, the tougher news on that is that sooner or later you have to deal with policy rollout, or the economic benefit cost of the split dollar policy becomes much bigger, and the gift tax consequences become really significant later on. So figuring out how to deal with that potential rollout and those increases later on are significant. Now, loan regime works a little bit differently. The premium advances by the employer are treated as loans to the employee, and to the extent that the loan has an interest rate that is below fair market for loan interest, that's a taxable transfer from the employer to the employee. The good news is that these days, with interest rates being relatively low, the income tax cost for participating employees is likewise fairly low. And so that's the good news from the employee's perspective. And in general, the crediting rates for life insurance policies tend to be higher than the current IRS imputed loan interest rates. So there's an opportunity for an owner of a policy, an employee owner of a policy that is treated under loan regime, to get positive arbitrage, because the cash value of the contract may grow quicker than the loan interest rate on the split dollar policy. And so it works a little bit like premium financing in that the employee can get cash value growth on the employee's side of the ledger. And that makes a lot of sense where you've got somebody highly compensated who you're trying to keep with the company, where you can sell the idea of positive arbitrage. And the poster child for this kind of implementation is the Jim Harbaugh situation at the University of Michigan. In the Harbaugh situation, the university was going to contribute, and has contributed, at least according to the documentation, $2 million of annual premium into the split dollar policy, and it's loan regime split dollar, if we can believe the documents that we've seen with regard to the arrangement. And Harbaugh stands to earn a substantial amount of equity in the policy if the policy performs as expected. That is, that the crediting rate ends up being higher than the loan interest rate. Now, for a more detailed look at the Harbaugh split dollar implementation, please listen to our December 2016 webinar. If you haven't heard that before and you want to hear it, give us a yell after today's seminar and we'll forward a link to it for you. So there are opportunities in the Harbaugh situation or other split dollar situations to provide benefits for an employee. There are also implementations that provide benefits for the employer, particularly where the employer owns all of the cash. The employer can get back some or all of its premium advances. The downsides are that it requires a pretty heavy-duty lawyer and agreement to draft up a split dollar arrangement, and you got to pay attention to the split dollar plan every year and administer it properly. And so for all but the most particular implementations, parties are not going to do that because of the expense and hassle associated with it. So that's why split dollar perhaps isn't more popular. So let's talk briefly about deferred compensation. When we talk about deferred compensation, we're usually talking about a supplemental employee retirement plan, or a SERP. Under a SERP, the life insurance comes second. The first thing that comes is the agreement between the employer and the employee. And under a SERP agreement, the employer promises to pay an employee extra later on. Usually that promise to pay extra starts at retirement. And it's typically an unsecured promise by the employer to pay something later on, meaning that it's not tied to a particular asset. And so the employer may decide, once the SERP agreement is in place, may decide to use life insurance, particularly permanent life insurance, to help it keep its promise later on. Permanent life insurance has several advantages from the employer's perspective. First of all, it provides a death benefit in case the employee dies early, so there's key man coverage. Secondly, cash values grow tax deferred in a life insurance policy, unlike an annuity that's owned by a business. And those tax deferred cash value growths can help provide the money needed to provide the income that the employer promises later on. And also, the death benefit can be used to help say to the employee, look, if you die early, we'll pay your family the benefit that we promised you at retirement so that your family won't lose out. So all of those things tend to make life insurance look pretty good in conjunction with a SERP plan. But the main downside is that the business doesn't get a tax deduction on the front end. So while a SERP seems to be everything that an employer would want, it gives the employer a lot of control over designing a compensation plan for an employee and allows the employer to highly influence an employee's behavior. What it doesn't do is it doesn't create tax-deductible life insurance premiums. The premium is paid after tax, and that's it. And it also requires a trip to a lawyer so that the agreement is put together in a way so that it conforms to the newish deferred compensation rules in Section 409A. And so again, you've got to make a trip to a lawyer to implement a SERP plan. But if it's done right, it can allow an employer to exercise a lot of control over an employee. But the trip to the lawyer on the front end and the fact that attention needs to be paid to it along the way in order to do it right means that isn't probably the best fit in most circumstances. And if we're talking about the owner of the company, particularly in a pass-through tax company like a partnership or an S corporation, it doesn't make any sense at all. A SERP wouldn't be the kind of thing that you would implement for the owner of such a company because the premium is not deductible and it's a hassle to put together. So that's a quick overview of the three types of deferred plans: deferred comp, split dollar, bonus arrangements. And oh, by the way, on deferred comp, you've got to make sure that 101J notice and consent has been honored and that you don't violate the 409A rules, because there are significant penalties for the employee if the employer doesn't do it right. So as I said at the beginning today, the most popular of these, in our experience, is the bonus arrangement. It's going to fit in 95% of your cases. But if you've got a circumstance where you're thinking that split dollar or deferred comp might be a better fit and you want to talk it over with somebody, feel welcome to give us a call. That's why we're here. We can help sort through those things and talk through the practical and tax aspects of these plans. And at this point, I'll wrap it up and turn it back over to Jennifer.
Thanks, Linus. And thank you for joining us today. And join us next month on October 6th for Charitable Gift Annuities, Misconceptions and Opportunities. As a reminder, if you would like to receive supporting materials about today's webinar, email us at asktheexpert@advancedunderwriting.com. Again, that's asktheexpert@advancedunderwriting.com. You may also email questions related to today's webinar to us. Finally, for more information about the services that Advanced Underwriting Consultants offer, including phone consultation and newsletter licensing, feel welcome to contact us at 615-224-1291. Again, that's 615-224-1291. Thanks again, and best wishes for continued success.